I'm going to talk about a fund I look after. This is a wholesale fund. It's a mid-cap income X30 fund. To go through the characteristics, what's the reason for being for this fund? There's a couple of reasons for it. We are in the camp that interest rates are low and they're going to stay lower for longer. There's, as George was going through, a search for yield. This product is designed to satisfy a particular area of that search for yield. And also, this point here, this dot point there, provides diversification away from large cap banks and telcos is important. The Australian share market, as you would know, is very concentrated. It's the top 20 is some 60% of the index. And there's a lot of the high yield names in that, such as the banks, Wesfarmers, Woolies, all well-known names. But outside of that, and a lot of people are concentrated and own those stocks. Outside of those stocks, is there yield? Is there area that you can invest in outside of the large cap stocks and still get a good yield and putting together a conservative portfolio, get an earnings stream from those X30 stocks? And that's how this product is being designed to specifically fill that niche. It's a niche product specifically designed to fill that purpose, to blend with if you have a larger portfolio of large cap stocks. So what? Just some of the characteristics of that. You'll see that this fund's been running since December 2012, so coming up to its 3 years anniversary. Also that since its inception, it's basically tracked with a dividend yield about 100 basis points above the market. That's a grossed up yield. So grossing up for franking, it's been about 100 basis points above the ASX 300. High franking's good, but these last 2 points are very important because when you go outside of the large cap stocks, there you start to get variability in company quality. So we are specifically looking at stocks with lower volatility, balance sheet strength, have business models which throw off a lot of cash, do not vary that much, and also stable earnings and solid dividend growth. So we're skewing the portfolio towards being relatively conservative outside of the top 30, and that's been as we go through this, you'll see evidence of that. This is a bit of portfolio theory for you here. It's also quite. What it shows is that how this product blends with this large circle here is basically an existing large cap portfolio. So that would be someone holding a lot of banks, Woolies, Wesfarmers, any of the Telstra, any of the large cap dividend yield companies. And a lot of people own that. That's a bedrock of a lot of people's portfolios. Now, what we're saying is this orange bit here is the X30. If you blend that with the existing portfolio, what it does is, because you're adding a different group of stocks, you're diversifying your risk. And if those stocks are carefully selected to be low volatility and good business models, good balance sheets, what you're doing by putting them together, you're reducing your risk. That's risk along the bottom axis there, and return. So you're not giving up any return, and you're actually approaching a more efficient trade-off between risk and return. So that's it. That's the theory around for the reason for the being for the fund, and so we see this as blending with existing portfolios. And as you can see, as just starting down the bottom here, what this is telling you that compared to the banks are a huge proportion of the ASX 300, this fund is way underweight. Now you'd expect that given that we hold only stocks outside the top 30, so we're going to be underweight the banks, underweight BHP and Rio, etc., underweight Woolies and Wes there, underweight Telstra, and some big health stocks, some big energy stocks. That's all self-evident from what I've been saying, that's the way the portfolio should be constructed. Up the top here is where we see the value for the fund and where we've positioned the portfolio. Miscellaneous services is that's made up from companies such as the gaming companies and the lease companies. I'll go through a bit more detail on those. Again, the underlying theme of the companies that we're putting into this fund are strong balance sheets. They throw off a lot of cash, relatively predictable. That's what we want. We want predictable results from these. So because we're after the dividend that these companies will throw off into the future. Also, some REITs, so as good stable income coming out of those. And these two down the bottom here, retailing and media, you're starting to get into more cyclical exposure. How we handle that is we pick the eyes out of them. We're very choosy about the companies that we put into that, and also they hold a lower position, a lower weight in the portfolio. So we adjust for that risk in the portfolio construction. What you see here is the existing portfolio as at September, with the 10 largest holdings and the 10 largest underweights. The underweights are self-explanatory. They're the 10 biggest companies in Australia. And so as this fund's the EX30, we don't hold any of those. So that's, you probably hold those yourselves, and you'll continue to hold those. And there's nothing wrong with that. On this side is the position of the portfolio. And so these top 10 positions, about 40% of the portfolio. As I said, it's the bedrock of the portfolio. What we want out of all these companies is basically to throw off a high dividend and sustainable dividends, and also to grow their dividends. And so, again, low volatility, predictability, no big surprises. If the share prices move around a lot, then so be that. We are interested in, as long as they keep their dividend or increase their dividend and we get that dividend flow, then we're happy with that. Also, I'd just like to say on a couple of stocks that we avoid, to give you an idea in terms of stock selection. There's a lot of companies out there that are on the surface throwing off high yields, such as Capital Goods, and George mentioned Metcash. I mean, when we went through that, it was a process of saying, are those yields sustainable? What's happening with those capital goods companies? These are companies that provide services to BHP and Rio, etc., and the other big coal miners. What's happening there is those guys are cutting costs incredibly fast. So when we look at that top line, when we look at that dividend yield, our view is that that's unsustainable. We don't want the whole stocks where they're going to cut their dividends dramatically. That also goes for Metcash. When we looked at that, there's a company that its balance sheets is okay. Its earnings are very stable. But when we look at what's happening in that industry with the new entrants, Aldi, etc., and Coles and Woolies getting much more aggressive, what's going to happen in Metcash? We said, geez, that's on the surface it looks attractive, but given those industry dynamics, it's not for us. It was never in this fund. And when it passed its dividend, we said, well, yeah, that's we don't want companies that there's a risk of passing their dividends in this fund. Now, there's a lot of numbers on here. This is the portfolio characteristics, so looking at the risk exposures of this portfolio. So what you've got here is the fund itself. Here you have the All Ordinaries. Here you have the top 30 and the EX30. Now, there's a couple of things that jump out of these numbers. The first one is that the average market cap, or the median market cap of the fund is quite high compared to the All Ords. So what we're buying here is established businesses. Businesses have a proven track record. Businesses that throw off a lot of cash. So though they're not top 30 companies, they are reasonable size. The PE is a little bit below the market. Earnings growth is above the market, given what's happening with the issues happening with the large miners and the banks. So that's given the conservative nature of the stocks in the portfolio, that 5% earnings growth is reasonably good. As I mentioned before, in terms of this is an area we specifically target. We like to keep that 100 basis points above this, the All Ords. So you've got 120 there at the moment, and we purposely skew towards, we explicitly value franking in this fund, and so we have a high gross yield, and as I said before, it's run about 100 basis points at least above the market. The other area we specifically target is the beta. This is another measure of risk. Keeping that lower than the market is evidence that the fund is skewed towards a lower risk profile than the market and less variability than the market. This is the performance of the fund. So you've got obviously got the fund down on the left-hand side, the All Ords accumulation, and then the difference. As I said previously, it's been running since December 2012. Now this is there's some reasonably large numbers there. Probably that's a product of two things. Firstly, there's been a reduction in the cost of capital. These type of companies we're investing in have become more popular. Their share prices are rising up. And also that the ability to pick the better stocks out of into the portfolio, so the value add that we'll get there. You're probably wondering what type of stocks have got lower down that have contributed to these returns. So I'll just go through some of the stocks that we hold in here that have all contributed over 20% since the initial time we bought them into the fund. So these are, we think, quite conservative companies that have still done quite well in share price terms. So SG Fleet is one of our smaller holdings. It's a capital light lease company, so it does a lot of the leasing, the car packaging for a lot of the public service, etc. This is a job a lot of companies don't want to do themselves, so they outsource it. SG Fleet does that for them, and so they get a fee for doing that, and they're growing their share quite successfully in that. As I said, it was capital light, and also was throwing off quite a high yield when we bought it. Challenger is up over 30% since we bought it. Going back a while ago, people were a bit reluctant to embrace the whole annuity and strategy and what they were doing there. So this stock has some growth to it because our belief is annuities will become a big part of the Australian investment scene going forward than what they are now, and Challenger will play a part in that. Back then it was offering a quite attractive yield. So, and it even though it is a capital intensive company, it's relatively stable. So we liked our position and took a position in Challenger. Another one is Supercheap Retail. We're up over 25% on that since our initial position. As I said before, in terms of retailers, they're a bit more volatile. We pick the eyes out of what we put in the fund, and also we look to see what type of weight we put in it. We look and examine that very closely from a risk-return perspective to keep their weights at a modest level compared to the rest of the fund. But Supercheap Retail has done very well for us. Macmillan Shakespeare, again, over 20% since we first bought it. This is a little bit similar to SG Fleet, except it also has a leasing business on its balance sheet, and does salary packaging. Again, another area that companies don't like to spend time doing themselves, so they outsource this, and they've grown into that area. So they've been successful in that, and they throw off a fair bit of cash as well. Macquarie Atlas, up over 20% since we first bought it. This is the old MIG, which you may sort of ring a bell back from the dim dark past of Macquarie Bank when it floated out. It had toll roads around the world. It went through some hard times, started paying down its debt, got its house in order. At the moment, its debt is the same type of profile as Transurban. So it looks more like a normal toll road, how that should be financed. There was still a little bit of a concern over a few bits and pieces with it, but we had a look at it and said, we like that yield, we like the stable position that the toll roads have of throwing off cash. Its balance sheet is now in order. It did a deal, and it also recently did a deal with the French government, a favourable deal, extended its concessions there. So that's been one where we like to see companies where the market starts to price it for less and less risk, and we get on that process. Also, Covermore is another one which since we first purchased it up over 20%. This does travel insurance, so it started off with being Flight Centre's big partner on this. Travel insurance, I cover the insurers as well, so Suncorp, IAG. It's a very problematic area for the big guys to get into. It's very management intensive. It's a specialist area. These guys are specialists at it. You've seen the big guys retreat, and so they're gaining share in that area. Again, very capital light business. It threw off a big dividend, and a reasonably stable business. So we like that one. Now, just what happens with what we like to happen with these companies is they basically earn their way out of the portfolio. What I mean by that is if we're doing our job, we buy them when they're yielding 6% or 7% grossed up. The market begins to like them. They price that down. The share price goes up. The yield falls. If it falls too far, we sell them and buy the next one. So the fund will slowly rotate with new ideas that offer high yields. So that's how the life of the fund will go. So hopefully I've explained how the reason for being for the X30 and how its performance has come about, and we see this as the search for yield, the search for income. It's ongoing, and it fills that niche that is very difficult to do for an individual or an investor without blending and taking out that risk. This chart is this is the final chart from me. You've got a lot of, it actually looks very complicated. It's very simple. As we went previously, I said that this is a low volatility fund, lower beta. The orange lines are the fund, the grey lines are the All Ords. So you can see that it moves to a lesser degree. So it's less volatile than the market, as you'd expect after all I've been saying, that it should behave in that way. And from Jan 13, and through its whole life, it's behaved in that way, as you'd expect. Thanks a lot for your time. I'd like to pass on to our microcap manager, Bill Lester. Thank you.